Hey there, welcome back to the channel. If you're interested in investing but not sure where to start or how to tailor your strategy, today's video is for you. We're breaking down investment strategies based on your personality type. So whether you're a risk taker, a cautious planner, or someone in between, I've got a strategy for you. Let's jump in. First up, we've got the risk-tolerant aggressive investor. If you're someone who thrives on excitement and high returns, and you don't mind taking big risks, then this is likely your style. These investors are constantly looking for high-growth opportunities, whether it's stocks, options, or even cryptocurrency. Aggressive investors are all about high-risk, high-reward assets. Think small-cap stocks, tech startups, and yes, even cryptocurrencies. They're also known for leveraging margin accounts and taking big bets on risky assets. These investors are all about market timing, trying to buy low and sell high, and they'll typically make decisions fast, often driven by emotions or news trends. They often use technical analysis, looking at chart patterns, volume, and indicators like RSI, Relative Strength Index, or MACD, Moving Average Convergence Divergence, to predict price movements. The goal? Big returns, but with the risk of significant losses. Risk management is key here. They use stop-loss orders to limit their downside, and might also hedge their bets with options or other derivatives. But even with all that, they're okay with the volatility because the potential rewards are massive. Example investments might include growth stocks like tech companies, cryptocurrencies like Bitcoin or Ethereum, and leveraged ETFs that aim to amplify returns on market movements. Next up, we have the cautious analytical investor. If you're someone who values data and research and you don't want to take big risks, this is your style. These investors take a slow, steady approach and focus on making well-informed decisions. They rely heavily on fundamental analysis. This means looking at things like PE ratios, earnings reports, and balance sheets to determine whether a stock is undervalued or not. They're the opposite of momentum investors. They're not chasing the next hot trend, but instead focusing on companies with stable earnings and growth. These investors typically follow a value investing strategy, which means they look for stocks that are trading below their intrinsic value. They focus on capital preservation, avoiding unnecessary risk, and investing in solid, well-established companies. They're big on diversification to reduce risk. Rather than putting all their money in one sector, they'll spread their investments across stocks, bonds, and real estate. Their portfolios are often a blend of blue-chip stocks, dividend-paying companies, and low-risk bonds. Example investments might include blue-chip stocks like Apple or Coca-Cola, dividend-paying stocks, and government or corporate bonds. Index funds and ETFs that track the broader market are also a popular choice. Now, let's talk about the balanced, pragmatic investor. If you're someone who likes a little bit of both, growth and stability, then this strategy is perfect for you. This investor strikes a balance between risk and reward, tailoring their portfolio to meet both short-term and long-term goals. These investors use asset allocation to manage their risk, usually with a portfolio that might be around 60% stocks and 40% bonds. They want the growth that stocks offer, but the stability that bonds provide. This balance helps smooth out market fluctuations while still capturing some upside. They also use a mix of growth investing and value investing to capture opportunities on both sides. You'll see these investors buying growth stocks for long-term capital appreciation, while also buying value stocks for stable income and lower volatility. One key aspect is regular portfolio rebalancing. This means they periodically adjust their investments to make sure the mix of assets still aligns with their risk tolerance and financial goals. Example investments for this strategy might include a mix of growth stocks, blue-chip stocks, corporate bonds, and real estate investment trusts, REITs. Balanced mutual funds and ETFs are also a great option. Next, we've got the passive long-term investor. This type is all about simplicity. If you're someone who doesn't want to worry about daily market fluctuations and prefers to let your investments grow over time, this strategy is for you. They embrace buy and hold strategies, investing in index funds or ETFs that track the broader market. This allows them to capture long-term growth without having to pick individual stocks. They're also big on dollar-cost averaging. This means investing a fixed amount at regular intervals, no matter what the market is doing. It helps mitigate the impact of volatility, ensuring you're buying into the market at different price points over time. The key here is long-term wealth accumulation. These investors don't stress about short-term market moves. They're in it for the long haul, typically holding their investments for years, sometimes even decades. Example investments for this strategy might include broad market index funds like the S&P 500, total stock market ETFs, or target date funds that automatically adjust their asset allocation over time. Finally, we have the speculative opportunistic investor. If you love chasing trends and seizing opportunities as they arise, this style is all about high risk and the potential for massive rewards. These investors are constantly looking for the next big thing. They might dive into penny stocks, cryptocurrencies, or NFTs. They're not looking for steady returns. They're going after explosive growth in short time frames. They're big on derivatives, using options and futures to amplify their bets. And of course, they're often using leverage to maximize returns. But this comes with a lot of risk, and if the trade goes wrong, they can lose big. Speculative investors are also keen on market sentiment, often making moves based on hype, social media trends, or news stories rather than traditional financial metrics. Example investments here might include penny stocks, cryptocurrencies like Bitcoin or altcoins, NFTs, and leveraged ETFs. The key is timing and finding opportunities in emerging markets. So there you have it, 5 different investment strategies based on personality type. Whether you're a risk-loving day trader or a patient, long-term investor, there's a strategy that can fit your style. But no matter what, it's important to understand your own risk tolerance, your financial goals, and your approach to the market. Let me know which type you identify with in the comments below. And if you found this video helpful, don't forget to hit that like button and subscribe for more tips on how to make the most out of your financial journey. See you next time.